Welcome to the Mutual Fund Show. I'm Neeraj Shah. In the next 20 minutes, we'll talk all about some aspects of mutual fund investing. So this episode, we're going to talk about what should you do with small cap funds. Should you invest in one of the better performing funds of FY22, or should you choose a completely different set of funds in the small cap space? Of course, we'll also ask our experts if you should invest in the small cap space in the first place. Is there a danger to investments in InvestcoMF schemes? There's a lot of talk around that for the last couple of weeks. It'll be important to get our guest perspective on that as well. And between gold and gold ETFs, for somebody who's looking to be conservative and try and diversify and wants to choose investing in gold, which is not physical gold, should you choose a gold fund or a gold ETF? We'll try and talk about that as well. And of course, a question that came to a mind of a lot of people, and including our guests who talked to us when the AMFI data was out, is the kind of outflows that we saw from the debt funds. We'll ask our experts to comment on that. Our experts today, Amol Joshi, founder of Plan Rupee Investment Services, and Kirtan.shah, founder and CEO of Credence Wealth Advisors. Gentlemen, both of you, thanks for joining in. Amol, can I start off with you first? Small cap funds, is this a good sphere to invest in looking at the current uncertainty in the markets? And if so, would you choose one of the winners of the yesterday of FY22, or would you go for a completely different set of funds?
Neeraj, hi, good evening. Thanks for having me over on the show. To answer your question, yes, why not? If you have a long enough investment horizon, something to the tunes of 7 to 10 years, 5 years more, definitely yes. You can choose to invest into small cap funds. That's my quick take. That is for somebody who wants to do the bifurcation as per market capitalization. If you are somebody who completely wants a bare bone 3, 4, 5 mutual fund schemes portfolio, then probably a multi-cap or a flexi-cap fund as 1 or 2 offerings would do good for you. But if you have decided to invest in a small cap fund, I think you mentioned one of the better performing funds of last year. One such scheme is Nippon India Small Cap Fund. It is incidentally also the largest mutual fund small cap scheme by assets under management. It is one of the better performing schemes as well, not just over last 1 year, because especially you mentioned that, but over last 1 year, 3 year, 5 year, 10 year. Across the time frames, it has consistently managed to beat its benchmark. So they have certainly something right going on for themselves. Now, what those right things could be? The way we have seen portfolio of the scheme, what we like about it is, as a small cap fund, you also are prone to kind of face a lot of accidents in the portfolio. Small cap companies, although listed, are not very well tracked and covered in terms of the research aspect of it. So you emphasize a lot on the research, on the quality of management. Your business should be high growth business, and all said and done, you should have a reasonable margin of safety. In other words, you should not overpay in buying a business. That's the philosophy that this fund uses. So I would say yes, to summarize my answer again, you can look at investing into small cap funds if you have a long-term investment horizon, and you can look at one of the better performing schemes, the scheme that we discussed just now.
Well, Amol, thanks for that. Yes, viewers, maybe a standard thing that I think a lot of our guests say, and we've said it so many times on the show, don't sort the performance by 1 year and choose a fund on the basis of that. That might be the worst possible thing that you could do. It could work, but it's not necessarily the best way to approach a fund. So by the way, just for clarity, the best performing small cap funds of FY22, and the list included Quant Small Cap Fund, which is probably the best performing fund, but Quant Small Cap, Canara Robeco Small Cap Fund, Nippon India Small Cap Fund, and BOI AXA Small Cap Fund. Each of these delivered returns northwards of 40%, with a couple of them delivering returns above 50% as well. Kirtan, the same question to you. Are you in favor of clients choosing small cap funds, either as a part of your portfolio or a larger part of the portfolio? Or do you believe that looking at the uncertainty, it's better to not? And of course, if your answer is a yes, are you choosing one of the better performing funds of FY22, or do you have a completely different set of funds?
So Neeraj, thanks so much for having me on the show. Ideally, if you look at the risk return data points, I think the answer to this question is very simple. That if you allocate equal proportion to a large, mid, small versus a multi-cap or versus a flexi-cap, you will see that on risk return basis, the large, mid, small has delivered a much superior performance than investing in a multi-cap or a flexi-cap. So for somebody who's very clear that she has 5-7 years of investment horizon at least, right, should definitely do a large, mid, small bifurcation in the fund, then rather choosing a multi-cap or a flexi-cap, in my opinion. And that's how I would like to believe that is a better portfolio building strategy than just investing in 2-3 multi-caps or 2-3 flexi-cap and let the fund manager decide what she really wants to do. Point one. Point two, of course, while you are trying to look at investing in a small cap, I think I would definitely not advise anybody who's got anything less than a 5-year, 7-year time frame to invest into a small cap, irrespective of what the last 1 year's performance has been, right? In fact, in the current situation, I think it is more of a problem is because you are not very sure of whether the valuations are correct to be paid at this point in time. There's too much of a macro overhang, and that can definitely have a stronger impact probably if markets have to move southward. So that's my larger piece on what you should really do with a small cap. Talking about fund specific, Neeraj, I think I'll tell you the bigger challenge that I see on the small cap side is actually the AUM of the fund, right? And all of us know that everybody keeps moving on to a fund that has been performing and the AUM keeps increasing. Let me give you examples of the two funds that Amol and you both spoke about. So Amol spoke about Nippon Small Cap and you mentioned Quantum, right? Now, both of these funds started in 2013, right? So they have a good 8-9 year of history that you can go back to and see if funds have done well. Now, I don't want to talk about returns is because if you look at the returns, both the funds have done really well, right? But a couple of data points, right? So if you look at Nippon is today managing close to 19,200 odd crore worth of AUM, right? This is as of 31st March. Now, if you look at the 251st stock, which by SEBI definition gets categorized as small cap, the market cap of that stock is almost as good as the AUM that the fund is managing. Now, because of that problem, you will see that so much of AUM does not get deployed in the small cap space, right? To analyze what I'm trying to say, Nippon has 141 stocks in which they've invested, precisely for this reason, because they can't do investing of 19,000 crore rupees in small cap. Also, if you drill a little deeper, we will understand that the exposure to small cap is only 45% of the total portfolio, right? Because you have the leeway to move around in large cap, mid cap. They only have 45% investment in the small cap space. And this is actually a problem across all small cap funds, at least on the performing side of the stocks. Versus that, if you look at Quant has moved up very aggressively in the AUM that they've been able to gather over the last 1.5-2 years because of the performance. But they're still close to 1,600 odd crore worth of AUM. So if you talk about AUM, I think Quant is in a much better position than probably a Nippon is, right? And that also goes in the same direction that I said, that they're only managing 56 stocks because the kind of money that they have to deploy, they don't really have to go out and gather 150 stocks, right? And basis that, if you look, the exposure to small cap in a Nippon is 56%, which probably is the highest in most of these funds that we are discussing today. So when we talk about a small cap fund where you want the fund to take exposure to small caps, I think lower AUM, higher exposure to small cap, and a lower turnover ratio probably works well in my favor. So I would not mind looking at a quant small cap as well.
Okay, Amol, just before we move on to the next topic, any thoughts around this? The AUM for Nippon certainly high, and does it become difficult for them to outperform in the times to come, or you disagree? I mean, and both of you could think about it completely differently, so it's okay.
Yes, sure. So Neeraj, this is not the first time size question has been asked, and Kirtan is absolutely right in bringing size into the mix. In fact, I myself have asked this question not just in this space of small cap, but including in large cap. One of the largest, senior most CIO has faced this question for last decade, and he has presented this data saying that in India, the fund sizes themselves are so small. Small cap could be slight an exception because you have to invest into 250 first and for up to 500 stocks only. But to cut a long story short, I think till the time fund has been able to manage, I think investors should probably investors should probably overlook that factor. We have long way to go, and we have seen that the way market capitalization as well as new companies are coming into the picture, I think we will have the investment universe. Fund manager will have the investment universe to deploy the funds. Last but not the least, we have seen small cap funds stopping subscription. And if the time were to rise, I would trust judgment of Nippon, equity investment team to probably halt the subscription till the time they do not find the fresh opportunities.
Okay, fair call. So viewers, a couple of funds to ponder over and some thoughts to ponder over whether or not you should do it in the first place, and if you're doing it, what are the kind of funds that you should choose, and whether you should, kind of leave it to the discretion of the fund manager by choosing a multi-cap fund or a flexi cap, but a multi-cap more strictly divided, or you choose each fund individually and then try and do the analysis yourself. Frankly, if you are investing in funds as well, it's best that you take some time out of your calendar to try and analyze some of the funds that you're investing in, the strategize for optimal returns. Okay, for somebody who wants to be on the other side, the small cap investing, largely perceived to be high risk, gold investing, largely perceived to be risk averse. And Kirtan, I want to start this argument with you. One, should people choose investing in gold through the mutual fund or the ETF route? And what is better? Should people who want to pure play invest into gold, should they choose a gold ETF or a gold fund? What's the difference between the two?
I think you should definitely have some exposure to gold. We've seen how COVID played out when equity was falling for the first half, and how, to a certain extent, initially gold actually balanced out the portfolio. I mean, that may be one of the examples that I'm talking of, but I'm sure largely all of us understand that probably it gives you a balance in the shorter time frame for sure. So I'm in for gold in terms of investment in a portfolio. Now look, for me, gold ETF theoretically is low cost. It does not have an exit load, right? A lot of other things kind of work with gold ETF largely, but I think it is meant for savvy investors and not for a retail investor. Now, why do I really make that point? Look, because the biggest advantage of a gold ETF, apart from the cost that everybody keeps talking about, is to be able to time the market, right? So while you're trying to buy gold ETF, you can buy it within the live markets, and you can pinpoint on a price at a particular time that you really want to buy it at, and you can get that. Versus that, while you talk about say HDFC savings fund or any other gold fund, let's say, right, the FOF category, what it does, it gives you the end of the day anyway. So largely, if you see, while you talk about ETF, one of the largest reasons why a lot of savvy investors want to do ETF investing, probably in my opinion, is not the cost, but the ability to be able to time the market, which adds a lot of value, which the FOF can't bring on table. But I think this is a big disadvantage to the retail investors. The reason being is because you really need the ability to be able to time the pricing of buying and selling, right, at the first instance. The second is the illiquidity, because of which there is a huge pricing gap, right? So even if the fair value is 100, it is not necessary that you will get the ETF at 100, right? So even if there is a 15 basis point cost extra in the FOF, right, but you might easily be able to lose out much more than 0.5 if there is this liquidity gap, because of which the pricing is not correct, and which is very common in our markets, right? So in my opinion, if you are a savvy investor and you can understand timing, being able to buy this from the market, understand the illiquidity gap, or if you have a higher volume, because of which you can reach out to the AMC and create your own units, you can go for ETFs. For most other retail investors who want to systematically accumulate gold, want to do SIPs, I think gold FOF is, in my opinion, a better proposition to invest in a gold ETF.
Okay, thanks for that, Kirtan. Let me first come to Amol, then I'll probably try and get one or two names for people who want to choose this route, and if you're convinced by Kirtan's answer, where you should go ahead. Amol, what's your thought though? First, the primary thought about whether people should do this, and if so, which route is better, an FOF route or an ETF?
The first answer is very, very clear, Neeraj, in my mind, that certainly you should have some allocation to gold, precious metal. This goes hand in hand with what what most of the planners, advisors, distributors would tell you. And it is proven by the empirical data as well, that prime driver of your portfolio returns is asset allocation and not security selection. So precious metals, gold, as well as international equity are all the diversification tools, satellite, asset allocation, assets rather, to your core equity and debt portfolio. So that answer is very, very clear. You should have investor exposure to gold. Second point, yes, most of the points was what Kirtan made. He's spot on. Couple of more points that I would like to add is ETF, by the very nature, you have to buy from stock exchanges. So not every mutual fund investor necessarily has the demat and trading account. So if you want to essentially buy ETFs, you should go make that effort of opening a demat and trading account, which adds to your overall cost and overall administrative hassle. That's number one. Number two, most of the brokers, some of the brokers do, but most of the brokers, equity brokers, the old school brokers, do not have the ETF SIP or stock SIP or ETF SIP kind of concept. The systems are simply not capable of that. Number three, we have seen last month SIPs have touched the all-time highest contribution from investors, and this is not unrealistic to assume that investors would want to take gold exposure as well via SIP route. Given all these constraints that ETF has, including the non-transparent price discovery, and most of the times, all the times, it will be against you. When you are a buyer, you will get to buy ETF units at premium, and when you are a seller, you will have to sell it at discount. That's exactly how price non-transparent discovery works. Given all these reasons, I would say most viewers, listeners, most lay investors would do a lot better via investing through a gold savings fund as compared to an ETF.
Okay. So again, very interesting arguments from both. Amol, can I come first to you and ask you what are the options available? I mean, it need not be an exhaustive list. It need not be the only ones that you recommend, but give us one or two which viewers right now or listening or readers who would read this story on the weekend might be able to invest into.
Absolutely, yes. So you have options like, so what is a gold saving fund? Gold saving fund is nothing but a fund that invests fully into gold ETF. So your actual underlying is exactly the same. Only the product wrapper, product construct differs. So every AMC and definitely all the larger ones do offer gold saving fund as a product. It includes HDFC, ICICI. You can simply choose within ETFs, as we have discussed earlier, pricing or the expense ratio is one of the important criteria what attracts many people towards ETF. Just keep it simple. Choose any of the gold saving funds where you find the lowest expense ratio within the product. There are, of course, other factors that you should look at, but expense ratio, since the underlying is the same, expense ratio is probably the most important. And a couple of options that I already shared with you, ICICI, HDFC, Nippon, SBI, all of these AMCs do have a gold saving fund. You can look at probably HDFC gold saving.
Okay. Kirtan, your thoughts on the components as well? You want to just respond to anything that Amol raised as well, and the options available on the ETF side?
No, I think he definitely mentioned all the other things that I would have given the time I had. So
of course.
But like he rightly said, I think while you're trying to choose any fund, he's already named HDFC, which I was also supposed to say. So along with the expense ratio, if at all the viewer understands slightly more, there is another component called the tracking error that she should look at. I think that can give you a slight edge on selecting the right fund. So I would say choose any fund which has the lowest tracking error and the lowest expense ratio. Of course, the tracking error is an element of the ETF, but because ETF is the underlying, I think your FOF is going to drive the same returns that the ETF is going to drive.
So Kirtan, you are saying that the lady, when she wants to choose the fund, should look at the tracking error, lowest tracking error of the underlying ETF,
yes,
if she's choosing an FOF mechanism, right?
Yes.
Okay. Perfect. Thank you so much. Thanks for that. So, viewers, there you have it. Both our experts believe gold should be an integral part of the portfolio, not just now, probably even otherwise. So, keep that at the back of your mind. Okay, now, so many of you would have some thoughts about maybe unfounded, but I'll let my guests answer that, about whether there should be any issues if you have exposure to any of the Invesco MF schemes. So, Amol, do you want to respond to that? Should people be concerned?
Should people be concerned? The kind of allegations that we have seen, at least in the media reports, allegations or the whistleblowers details that are available in the media. The way I would like to look at it is, regulator is already on the job, authorities are already on the job. That's number one. If there was something exceptionally wrong, a big red flag, then I think we would have heard from regulator. But I want to completely look at it from a different point of view. I would like to take you back to April 2020, when mutual funds in general and debt mutual funds in particular probably faced their biggest asset test and the biggest shock that was possible that you could get in history,
Sure.
as well as over last, any period that we have been working in mutual funds. What happened? 1.5 years later, investors recovered 100% of their monies, and still some. There are still some payments to be made from 6 wound up schemes of Franklin Templeton Mutual Fund, most of them into debt and credit, all of them into debt and credit category. What I'm trying to say is we have to differentiate, viewers and all of us have to differentiate how a mutual fund operates. Mutual fund has a very well defined regulatory structure where you have a trustee, where you have a board, and where you have independent fund management teams. And in fact, I would say it's a good news that there has been a whistleblower who has been able to put out some facts which were not in line with the regulations. And as they say, sunlight is the best disinfectant. As things come out in the open, I think mutual funds, not just Invesco, but overall ecosystem will only get stronger from here. The way we, all of us, debt mutual funds, again, in particular, got stronger after the schemes winding up scenario. I would say not to jump the gun, for the simple reason that when everybody dashes towards the exit door, hardly 1 or 2 or 5 can exit. Remaining people do get trapped inside. And that is also precisely something that happened in the winding up case, where the AUMs rapidly declined and then extreme measure had to be taken on the fund manager side. So I would say I would wait to hear from the regulatory authorities instead of, jumping the gun.
Kirtan, what about you? What are your thoughts?
I think very much on the similar lines that we should not really create panic unnecessarily, because these allegations are not proved as yet. But whatever I read from the media, I understand that the whistleblower was an ex-fund manager, right? Coming from somebody like him, I would not also completely ignore the fact that there cannot be something material in this. And if you look at the third allegation, which is the inter-scheme transfer, right, where we are saying that securities like DHFL were transferred to the offshore PMS. We've seen this happening even during the crisis that Amol spoke about, where debt funds moved their schemes to balance advantage fund category. Now, this is by no means wrong, right? This is absolutely not wrong in any legal structure or the way it is meant to work, right? But it just goes to show you how that particular AMC wants to run the show, right? So this is not a structural problem in my opinion, but this is more to do with how one particular AMC believes in a process. And in such a situation where you've got so many options available, right? I think a lot of us would not want to really risk our necks out and move into investing with a particular AMC. There are issues that we just spoke of. So of course nothing is proven. We are not talking about anything that has really gone wrong legally, but I think it is more to do with an investing process than anything else.
It's just a fantastic show. It's the first time that I've had guests with slightly contrasting opinions on all the 3 topics that we've spoken till now, in some fashion slightly contrasting, which is great actually. viewers get all the arguments. My final question actually, in Kirtan, I would love you to respond on this first, which is the kind of numbers that came out on the debt side in the recently released AMFI numbers, while some of the other some numbers like the SIP numbers, etc., looked okay. On the debt side, there was a fairly large number that came out. What did you make of that? Why did such large exits, if you will, happen from the debt portfolio, so to say?
Neeraj, I think if we break down the numbers, there was some, if I'm not wrong, 1.1 lakh crore worth of redemption that happened on the debt side. Out of that, close to 57,500 crore was liquid overnight. Now,
Sure.
This is very common and acceptable because it was year-end, quarter-end. You
Year-end.
would have treasury balance sheets, treasury selling to pop up the balance sheet. So I think if 57,500 crore was that, I think that does not require a lot of explanation. I think the other part that we really discuss is probably the popular categories where a lot of us invest, which is the corporate debt fund or the banking PSU or the short-term debt fund, which probably saw 29,000-30,000 crore worth of reduction. I think this is a discussion area which, in my opinion, is happening because the yields are extremely low, inflation is moving up, yields are not exponentially going up, and also if it is going up, it is hurting the NAV in some fashion. Right, and also there is an expectation of rate going up. There is so much of expectation that the rates will go up, but we've not seen RBI move the gun. RBI is trying everything possible to suck the liquidity out of the system, but the rates are not going up. So I think there is a lot of overhang on where and how the rates are possibly going to move. I think that is one reason why I think this redemption could really have triggered.
Amol, any thoughts here?
Neeraj, we on the very same platform, I think any show that we do just in the first month of the quarter, we always have the last quarter's data available to talk about. And half a dozen or if not dozen times we have discussed, and Kirtan made this point that treasury redemptions is a feature, it's not a bug. Okay, and just to supplement one more point, we also always forget that during quarter end on 15th, you also have advance tax payments. And that's where your liquid cash comes in handy to make those advance tax payments, just to supplement point to the previous argument. So that's one. Second one is you would have seen a slight uptick, especially from the smaller banks, where FD rates have slightly gone up with expectation that inflation is going up and the rates are about to harden. So I think some of the people, especially during the quarter end time, to freeze on the yields that are available on the banking side, probably would have taken money off the table. That could also be another reason. I want to add one more point to the mix. On the retail side, it would not move the needle much, but we cannot ignore it at the same time. March is also the month where you saw extreme movements in the equity market. So some of investors who had money in the shorter term funds, I think those investors, we have seen it in our book, those investors actually switched or fast forwarded their STPs to take the lump sum exposure. That also is one of the contributing factors, Neeraj.
Yeah, I'll wrap up the show with a quick 30-second answer from both of you. Amol, to you first. Hitherto, mutual funds were giving competition to banks, right, on the fixed income side. I hear of this whole concept of neo banks, which are giving interest rates as high as 7%. Why shouldn't an investor choose those over arbitrage funds or short-term funds, which may give maybe slightly better returns than FDs, but certainly lower returns than what the neobanks are giving?
Since it's a 30-second answer question, Neeraj, my 30-second answer is favorable tax treatment. If you hold debt mutual funds for more than 3-year period, you will get benefit of indexation. Post-indexation, your tax outgo will be substantially lower. That's a significant advantage that you cannot overlook. Okay,
thanks for that. Kirtan, to you, the same question really.
I think if you really want to park a small part of your portfolio, I would not want to choose the neobank, because if you look at, you said 7%, there are options which give 8%, there are options which are given 10%. Wow. BharatPe gives 10%, right, to a microfinance loan. I don't see a reason why, if you want to park a small amount of your money there, which is as liquid as anything else, you get that money in 2 days. A small portion can definitely be taken in exposure, provided the investor understands the risk. Look,
Yeah.
it's a very new platform, right? So you have to understand that risk. But I think there's no comparison of the return that they are giving versus what money markets are making right now.
But the Reserve Bank guarantees up to 5 lakhs any which is, right? Or correct me if I'm wrong.
So that's for the fixed deposit link thing. But if you take a Bharat Pay or a liquid loan kind of a structure, nothing is guaranteed there. So individuals have to understand this.
Got it. So, okay, understand the risks. Yeah. Well, maybe on a PF show, this could be a very pertinent question. Maybe we can do a whole show around what are the fixed income options available in addition to mutual funds. If we've all through the last 4 years told viewers that look at funds over fixed deposits and banks accounts, and now if there are other options available, it might only be justified to try and look at those versus the options that mutual funds are giving. So both of you, thank you so much for this food for thought. Maybe we'll do it on another show. But for today, thank you so much for being a part of this mutual fund show and giving us your thoughts.
Always a pleasure. Thanks, Neeraj.
The pleasure is ours, both of you. Thank you. And viewers, thanks for tuning in.